Welcome to the complete series recap for ASC 505 Equity. Over 7 sections, we have built a thorough understanding of equity accounting under U.S. GAAP, from what equity is and how it is structured, all the way through disclosures, the comparison with IFRS, and audit readiness. This recap brings it all together in one consolidated review. The series covers 7 core areas of equity accounting. Section 1 established the foundation, what equity is, its 5 components, and the key vocabulary. Sections 2 and 3 moved into the mechanics of stock issuance, including preferred and treasury stock. Section 4 covered every form of dividend. Section 5 tackled retained earnings, AOCI, and the equity roll forward. Section 6 applied all of that in journal entries and financial statement presentation. And Section 7 wrapped up with disclosures, the GAAP versus IFRS comparison, common mistakes, and audit readiness. Section 1 established the equity framework. Equity is the residual interest, assets minus liabilities, representing the owner's claim. The 5 components are common stock at par, a PIC for proceeds above par, retained earnings for cumulative net income less dividends, AOCI for items that bypass the income statement, and treasury stock deducted at cost. Par value is a legal minimum with little economic meaning. Most of the dollars sit in a PIC you must track for share counts, authorized, issued, outstanding, and treasury, and they must reconcile at all times. Section 2 covered every stock issuance scenario. The cash issuance journal entry is always the same structure: debit cash, credit common stock at par, credit a PIC for the remainder. Non-cash issuances use the fair value of whatever is more reliably measurable, the asset received or the shares given. Subscriptions create a contra-equity receivable, cash at payment, not at signing. Stock-based compensation is expensed against earnings with a corresponding PIC credit. No par stock is simpler. Full proceeds go to common stock with no split required. Section 3 introduced preferred stock and treasury stock. Preferred stock is senior to common in both dividends and liquidation. It has fixed terms that must be disclosed. Cumulative preferred stock accumulates undeclared dividends as dividends in arrears, disclosed in the notes even though no liability exists. Convertible and callable features require separate tracking. Treasury stock is a share buyback recorded at cost and deducted directly from equity. It is never an asset. When reissued above cost, the excess goes to a PIC. When reissued below cost, draw down a PIC first, then retained earnings. The income statement is never touched. Section 4 walked through all dividend types. Cash dividends are a 2-step entry: debit retained earnings and credit dividends payable on declaration date, then reverse with a cash payment. Property dividends require revaluing the asset to fair value first. Any gain or loss is recognized before the dividend is recorded. For stock dividends, the measurement depends on size. Small stock dividends under 20 to 25% use fair value. The amount debits retained earnings and credits common stock at par plus a PIC for the excess. Large stock dividends use par value only. Stock splits require only a memorandum entry. Section 5 covered retained earnings, AOCI, and the equity roll forward. Retained earnings grows with net income and shrinks with dividends and net losses. Appropriations are internal board restrictions. They cannot absorb actual losses, which is a common mistake. AOCI holds 4 categories: pension actuarial gains and losses, hedging gains and losses, unrealized gains and losses on FS securities, and cumulative translation adjustments, or CTA. When the underlying items are realized, they reclassify out of AOCI into the income statement. The equity roll forward ties all of this together, every component from opening to closing, reconciled to the financial statements. Section 6 applied everything in journal entries and financial statement presentation. We consolidated the entry for every transaction type: issuances, repurchases, reissuances, all dividend forms, OCI items, and reclassifications. The statement of stockholders' equity is a full roll forward presented as a required financial statement. On the balance sheet, equity appears in a fixed order: common stock, a PIC, retained earnings, a OCI, and treasury stock as a deduction. Public companies must present both basic and diluted EPS. Redeemable instruments are separated into the mezzanine section between liabilities and permanent equity. Section 7 opened with the required disclosures under a SC 505. For every class of stock, you must disclose shares authorized, issued, and outstanding. You must describe par value, voting rights, dividend rights, and liquidation preference. Preferred stock needs its own note: the dividend rate, whether cumulative or non-cumulative, conversion terms, call prices, and liquidation preference. Cumulative preferred dividends in arrears are disclosed even without a liability. Any dividend restriction from a debt covenant must appear, and AOCI components and reclassifications are each separately disclosed. The GAAP versus IFRS comparison highlighted one major structural difference beyond labeling. A PIC becomes share premium under IFRS. Many jurisdictions have eliminated par value, so all proceeds go into one share capital account. The most significant difference is the mezzanine. U.S. GAAP requires a separate mezzanine section for redeemable instruments under SEC guidance. IFRS under IAS 32 has no mezzanine, binary classification only, either a financial liability or equity. Instruments that GAAP places in mezzanine typically become full liabilities under IFRS, increasing reported leverage ratios significantly. The 7 common mistakes from Section 7 deserve emphasis in this recap. Treasury stock reissuance gains never go to P&L. They go to a PIC. Dividends are not an expense. They debit retained earnings. Subscription receivables are contra equity, not assets. Always split common stock issuance between par and a PIC. Small stock dividends under 20 to 25% use fair value, not par. Stock splits require only a memorandum entry. And losses never go to appropriated retained earnings. Memorize these 7, and you will avoid the most common equity audit findings. Audit readiness comes down to documentation. Your cap table must reconcile authorized, issued, outstanding, and treasury shares to the general ledger. Every share issuance needs a board resolution and signed agreement. Every treasury stock repurchase needs a brokerage confirmation. Every dividend needs board minutes with the per share calculation, record date, and payment date. And you need a full roll forward for every equity component, each one tying to the financial statements. When auditors arrive, you should be able to hand them a complete package, not spend fieldwork assembling support. 5 principles tie the full course together. Equity is always the residual. Any change in assets or liabilities flows through to equity. Par value is a legal formality that creates the common stock and a PIC split. The real economic value lives in a PIC treasury stock. Dividends and subscription receivables never touch the income statement. Every equity transaction needs documentation before it is recorded: board resolutions, agreements, confirmations. And roll forwards are not a closing task. Build them throughout the period so audit support is ready from day one of fieldwork. The equity close process operates through clear roles that appeared throughout the series. The team member performs initial identification, classification, and recording for every transaction. They prepare supporting schedules, reconciliations, and roll forwards, and flag any unusual or borderline item to the team lead immediately. The team lead reviews all of that work and the disclosure drafts, escalating to the manager on anything requiring judgment or client communication. The manager approves all judgment calls, signs off on disclosures, and communicates significant decisions to client management before issuance. The overriding principle: Escalate early. You have now completed the full ASC 505 equity series. You can identify and classify all 5 components of stockholders' equity. You can record every equity transaction, stock issuances in all forms, treasury stock repurchases and reissuances, all 3 dividend types, stock splits, and OCI items. You can prepare the statement of stockholders' equity, write the required disclosures, and explain the key differences between U.S. GAAP and IFRS. And you can build a complete audit-ready equity package, cap table, roll forwards, board resolutions, and all supporting documentation. Thank you for completing the full ASC 505 equity series. Thank you for watching. Subscribe for more training from PNJ Group.